In December 2024, one of the most recognizable shows on the internet quietly changed hands. Hot Ones, the one where celebrities answer real questions while eating increasingly punishing chicken wings, was sold off, along with its studio, First We Feast, for $82.5 million in cash. The buyers were a group led by an affiliate of the Soros family's investment firm, alongside host Sean Evans, founder Chris Schoenberger, the podcast company Crooked Media, and Mythical Entertainment. The seller was BuzzFeed, which is strange because Hot Ones still worked. Tens of millions of subscribers, billions of views, the kind of loyal audience most media companies spend years and fortunes failing to build. BuzzFeed wasn't cutting dead weight. According to the company, the sale helped push its debt down toward $30 million. This was a company selling something very much alive because it needed the cash. And that detail tells you most of the story. Less than a decade earlier, BuzzFeed had been valued at around $1.7 billion. By May 2026, the whole company was worth about $31 million, its stock hovering near 73 cents. When a business that size starts selling its best work to stay afloat, the question worth asking is how the math got this bad. Let's go back to when BuzzFeed looked like it had cracked the internet. Mid-2010s, and BuzzFeed was a phenomenon. Founded in 2006 by Jonah Peretti, the company had taken the most disposable corners of the internet. The quizzes, the listicles, the recipe videos shot from directly overhead, and turned them into things that travel. Tasty alone could rack up tens of millions of views on a single clip of cheese being pulled apart in slow motion. And BuzzFeed didn't treat any of this as luck. It treated virality as a science. Test the headline, measure the share, feed the data back in, and run it again. The pitch wasn't, we make content. The pitch was, we've built a machine that understands attention. Investors bought it. Literally. Andreessen Horowitz, one of Silicon Valley's most influential venture firms, led a round of around $50 million. Then, in August 2015, NBC Universal put in $200 million, a deal that valued BuzzFeed at roughly $1.5 billion. A little over a year later, NBC Universal did it again, another $200 million, pushing the valuation to about $1.7 billion. That's $400 million from a single media giant, and close to $500 million in venture funding all told. BuzzFeed wasn't being valued like a media company. It was being valued like a tech company. Data, virality, and scale framed as a defensible moat. The trouble was that the revenue never quite read from the same script. In 2016, the Financial Times reported that BuzzFeed had missed its 2015 revenue target by about a third. The company disputed the figures. The next year, the Wall Street Journal reported a shortfall of 15 to 20% against a roughly $350 million goal, a miss large enough that the long-promised 2018 IPO quietly fell off the calendar. A tech company is supposed to compound. This one kept arriving like media, ad-dependent, and harder to predict than the deck implied. And that was the first hint at the real problem. The brand looked owned. The audience was rented. So who actually owned all that attention? Not BuzzFeed. For years, by most estimates, the large majority of BuzzFeed's traffic arrived through social platforms, and one platform mattered more than all the rest combined: Facebook. The feed was the front door. A quiz, a recipe, a listicle. It spread because Facebook's algorithm decided to show it to people, which was wonderful, right up until you remembered that BuzzFeed hadn't written that algorithm. It had simply optimized for it, brilliantly, like a tenant renovating a building it doesn't own. And the landlord kept changing the terms. The first tremor came in 2014, when Facebook adjusted its system to cut down on so-called clickbait, a category that, awkwardly, included a fair amount of what made viral publishers go viral. The bigger blow landed in 2018, when Facebook rebuilt its newsfeed to favor posts from friends and family over content from publishers. For a business whose distribution ran straight through that feed, this wasn't a tweak, it was a change to the foundation. What followed showed up plainly in the numbers. According to data from SimilarWeb, referrals from Facebook to BuzzFeed fell by roughly 92% compared with the spring of 2020. The site's overall traffic dropped about 60% from its 2021 level. Monthly visits that had once topped 150 million slid below 100 million. Then there was the other half of the trap. Even the advertising money flowed to the same gatekeepers. In those years, Facebook and Google together took more than 60% of all digital ad spending. So BuzzFeed was competing for attention on platforms it didn't control, and competing for ad dollars those same platforms were quietly absorbing. A company once valued for owning the future of media turned out to be renting both ends of its own business, the audience and the money. The distribution was already shaky. What came next would turn shaky into dangerous. Because BuzzFeed was about to bolt all of it onto a public market structure with almost no room for error. Going public is supposed to be the moment a company finally gets its hands on serious money. For BuzzFeed, it mostly didn't work out that way. In 2021, BuzzFeed went public, not through a traditional IPO, but through the era's favorite shortcut, a SPAC. A SPAC is a kind of empty company that raises a big pile of cash first and goes looking for a real business to merge with second. The money sits in a trust. The shell finds its target, and when the two combine, the target becomes a public company, quickly and, in theory, well-funded. For a stretch of 2020 and 2021, this was the hottest deal structure on Wall Street. BuzzFeed's partner was a SPAC called 890 Fifth Avenue Partners, and on paper, the war chest looked healthy. The trust held about $288 million. Lined up beside it was another $150 million in convertible notes, debt that can later turn into stock, led by an investment firm called Redwood Capital. The combined company was valued at roughly $1.5 billion. Except for one feature of how these deals work. Before a SPAC merger closes, its own shareholders are allowed to change their minds and pull their money back out of the trust. It's called redemption. And by late 2021, as the SPAC boom cooled and the enthusiasm drained out of the market, that's exactly what they did. According to the filings, around 94% of the trust was redeemed. Of the $288 million, roughly $16 million stayed. Instead of a few $100 million in fresh capital, BuzzFeed went public having raised about $166 million, and $150 million of that was the convertible notes. Most of the money it walked away with wasn't growth capital at all. It was debt. The same day the merger closed in December 2021, BuzzFeed also closed its acquisition of Complex Networks, a deal carrying around $200 million in cash obligations. Added up, roughly $166 million raised, mostly borrowed, against about $200 million committed to a purchase. The math was underwater before the ticker ever went live. BuzzFeed entered public life not flush with options, but carrying debt and a bill, with less room to maneuver than the day it was private. On the morning of April 20th, 2023, the staff of BuzzFeed News gathered to hear that their newsroom was being shut down. BuzzFeed News launched in December 2011 under founding editor Ben Smith, and over the next decade it became something its parent company's reputation never quite prepared people for: a serious newsroom. It broke real stories. It built an investigations team. And in 2021, it won a Pulitzer Prize for International Reporting, the highest honor in American journalism, sitting inside the company best known for quizzes about which kind of bread you are. The most acclaimed thing BuzzFeed ever built was also the most exposed to everything breaking underneath it. Premium journalism is expensive, and giving it away free means leaning on advertising and traffic to pay for it. And by 2023, both were collapsing at once. The social referrals that once carried BuzzFeed's reach were drying up. The ad market was tightening. And BuzzFeed News, the company said, was the only part of the business that wasn't turning a profit. That April, BuzzFeed cut about 15% of its entire workforce, roughly 180 people across the company. And at the center of that round was the decision to close the newsroom. It wasn't even the first round of cuts. The previous December, the company had already let go about 12% of its staff. The news operation that survived was HuffPost, which BuzzFeed had bought from Verizon in 2020. What makes the moment land is that the company's own founder named the causes out loud. In his memo to staff, Jonah Peretti pointed to a fading SPAC market that yielded less capital, and to platform shifts, the underfunded debut and the rented distribution, in his own words. He admitted he had chosen to overinvest in the newsroom, and, unusually for a chief executive, that he could have managed the whole thing better. Closing the newsroom stopped a cost. And BuzzFeed didn't just need to spend less, it needed cash and relief from the debt it had carried out of that SPAC deal. So the company moved on to the only lever it had left. It started selling the things it had bought. In February 2024, BuzzFeed sold Complex, the streetwear, music, and pop culture network, to a commerce company called Neckwork for $108.6 million in cash, plus a few million more in related costs. The same week, it announced another restructuring, roughly 16% of the remaining staff, with the company projecting about $23 million in annual savings. Strip out the corporate phrasing, and the message was simple: sell an asset, cut more people, buy a little more time. But the Complex sale carries a detail that tells you how the original bet aged. And in December of that year, it sold First We Feast and Hot Ones for another $82.5 million. Add the two sales together, and the company recovered roughly $191 million on a package it had paid close to $294 for just 3 years earlier. Round trips like that are not, generally speaking, the plan. Now, the Hot Ones sale makes sense. It was the next move in a sequence, selling something that genuinely worked, because what it fetched in cash mattered more than what it might have grown into. By the company's own account, these sales helped it strip more than $150 million of debt off the books in a single year, which left one question hanging over what remained: who was going to own it? Go back to early 2025. BuzzFeed's auditors raised what's formally called substantial doubt about its ability to continue as a going concern, the official warning that a company may not be able to cover its bills for the year. The trigger was those SPAC convertible notes, which holders could soon demand back in cash. So BuzzFeed did what pressured companies tend to do. In May 2025, it borrowed against itself, took a $40 million term loan, and used it to pay the notes off. Crisis resolved. Except the new loan carried its own terms, and by the time the company reported its full year 2025 results, the going concern warning was back. The bill hadn't disappeared. It had changed shape. The company reported full year 2025 revenue of around $185 million, down a couple of points, and a net loss of about $57 million, though much of that loss was a non-cash write-down rather than money leaving the building. And on an adjusted basis, the operation had actually gotten leaner. By the first quarter of 2026, revenue was down another 12%, The losses were widening again, and BuzzFeed held roughly $6.8 million in unrestricted cash, against some $60 million in debt. The stock had traded under $1 long enough to draw a NASDAQ delisting warning, and in April, the company missed a $5 million debt payment. At this size, that's not a rough patch. It's the floor getting close. Which is when the rescue arrived. In May 2026, the family office of media entrepreneur Byron Allen agreed to put $120 million into BuzzFeed for roughly 52% of it, majority control. But the headline number flatters the deal. Of that $120 million, only $20 million was cash, much of which went straight back out to pay down existing debt. The other $100 million was a 5-year IOU. For control of a company once valued at $1.7 billion, the real money on the table was $20 million and a promise. Allen became chairman and chief executive. Founder Jonah Peretti stepped aside into a newly created role, president of BuzzFeed AI. And the market loved it. The deal priced new shares at $3, and on the news, the stock nearly doubled, spiking around 156% in after-hours trading, according to Reuters. But strip away the excitement, and the rally wasn't really a verdict on the business. Existing shareholders had just watched their stake cut roughly in half. What jumped was the implied value of that smaller slice at the new, higher price. Even after the surge, the shares settled $1.60, still below the $3 deal price, still close enough to that delisting line to matter. The one analyst covering the company rated it a hold with a price target of $1. And the story BuzzFeed is selling now is artificial intelligence, AI-powered apps, tech-enabled content, and a real share of the market's enthusiasm rode on exactly that. Whether it becomes a business or stays a press release is the open question. The strange thing about BuzzFeed's story is that at almost every step, the decision made sense in the room where it was made. That's what makes the pattern worth keeping. There are 3 mistakes hidden underneath it. First, attention is not ownership. BuzzFeed built a genuinely brilliant machine for capturing attention, but it ran on platforms the company didn't own. And when those platforms changed the rules, the audience went with them. Reach feels like a moat, right up until the landlord changes the locks. If your business lives on someone else's distribution, you don't own your audience, you rent it. Second, culture is not always margin. The newsroom won a Pulitzer. Hot Ones pulled billions of views. People genuinely loved what BuzzFeed made, and the company still gave it away or sold it off, because beloved and profitable are not the same line on a statement. Cultural value is real. It just doesn't automatically turn into the money that keeps the lights on. Third, public capital can't fix weak unit economics. A SPAC, an IPO, a rescue investor with a famous name, each one changes who owns the company and how the debt is arranged. None of them changes whether the business actually makes money. Fresh capital buys time. It doesn't fix the math. Put them together, and the whole autopsy fits in a sentence. BuzzFeed monetized an audience it didn't control, at margins that were always thin, then spent years buying time the economics never paid back. It's a pattern you'll see again. Now you'll recognize it when you do. If you've got cash to burn, welcome to the Bagholder Association. And if you'd rather keep yours, subscribe. We'll watch billion-dollar companies burn theirs instead.